Hello everybody and welcome back to my channel. In this video I want to explain something that sounds complicated but actually isn't, and that's credit spreads, and more importantly, how can we use them in our trading. I also want to cover the current situation following tariff announcements and how credit spreads can help us to watch for a market bottom. So if you've ever heard anybody say things like credit spreads are widening or watch the credit markets, and you've thought, what on earth are they talking about? We're going to go through that in this video. So let's break it down really simply. So firstly, what is a credit spread? Well, basically, a credit spread is a way to measure how risky the market thinks it is to lend to companies, especially companies that aren't quote unquote like top tier companies. So it's effectively the difference between the interest rate that the US government pays to borrow money, and that's arguably the safest bet in the world, and the interest rate a risky company, again kind of quote unquote, that has to pay to borrow money. So for example, let's say the US government can borrow money at 3%, but a company with a lower credit rating has to borrow at 6%, then the credit spread is 3%. So the higher that number is, the more nervous the bond market is about risk. Now, you might be thinking, okay, cool, but I don't trade bonds, so why should I care? Well, when credit spreads go up, as they have been recently, and as is illustrated by this chart, we're going to talk a little bit more about the chart in a second, it usually means that investors are getting scared. So they don't, unless they get paid more for taking that risk. And that fear often spills over into stocks, especially riskier stocks. So if credit spreads start to rise quickly, as they have done recently, you can see this here, this was sort of mid-February, and this is most recently. And this is often a warning sign. It means risk is rising in the system, and it's not unusual to see SPX or S&P 500 start to drop when that happens. So very, very basically put, credit spreads going up equals potential SPX downside, and credit spreads narrowing or coming down means more confidence in the market and therefore potential SPX upside. Okay, so arguably the most important part here, how can we use this in our trading? Think of credit spreads like an early warning system. They often move before the market reacts, which means they can give us a little bit of a heads up when something's shifting in the background. Now, obviously, this isn't always the case, but here's what's really important to understand, especially in the current environment. When credit spreads are rising, like they are right now, it tells us that the bond market is getting nervous. Lenders are demanding more reward for taking on risk, and that means institutional money is still cautious. So if you're trying to get a sense of when the market might bottom, credit spreads are actually one of the best indicators to watch. They can also help indicate the start of a bear market when those come around. So you're not necessarily trying to perfectly time the bottom or perfectly predict a bear market, but this is one of the many things that gives us a clue as to when the environment is starting to shift from risk off to risk on, and vice versa. So here's the key. While credit spreads are still widening, it suggests the market bottom is probably not yet in. But when credit spreads start to narrow, come back down, meaning confidence is starting to return and risk appetite is improving, that's when we're more likely to be in the early stages of a bottoming process or even a market reversal. As with anything we evaluate, this is not some magical crystal ball, but it's one of those higher level macro tools that can help you to understand the broader risk picture, especially if you're someone who trades indices like SPX, or if you're somebody who trades more in swing positions. So if you're positioning for a bounce, it's good to be aware of what credit spreads are doing in the background. So how do you actually monitor and look at credit spreads? Well, unfortunately, credit spreads aren't the easiest to find on TradingView. they're not as easy to find as stocks and options, but the one I personally use is this one. I will put the ticker for this in the description because it's really long and kind of complicated. But this is the ICE BFA US High Yield Index Option Adjusted Spread. It's a very fancy name, but it basically tracks the average spread for high yield junk corporate bonds over treasuries. It sounds a lot more complicated than it is. You can type that into TradingView, or you can check it on sites like the Federal Reserve Economic Data website, FRED. But just keep in mind that the data on TradingView is delayed by a day. So if you're looking on, say, a Friday, you'll only see the credit spread data up to the Thursday. So we don't use this for scalping or intraday stuff at all. It's more for evaluation of general economic consensus. It's more of a macro backdrop. So if you do hop onto TradingView and have a look at this chart, you can also add the SPX chart to it and you'll see how it correlates with SPX. And you'll also see just at a very simple level, you'll be able to tell that credit spreads are higher during bear markets and also during times of economic uncertainty, or like the Black Swan event we saw in August. You can see credit spreads rose at that time as well. Now, ideally, I want to see credit spreads start to ease off a little bit before I enter the market and purchase any longer term stock holds. Obviously, for intraday scalping, this isn't really, I don't want to say it's irrelevant because that's not the case, but it's less important, let's say. But if you're buying longer term swing positions, if you're buying longer dated call options, if you're looking to repurchase stock that you maybe sold off prior to this big sell-off that we had, monitoring credit spreads may be helpful to you in terms of trying to get a bit of a better understanding of when we might start to see that reversal happen. So just to recap, credit spreads are basically a measure of market fear about lending to companies. When spreads go up, risk is rising, and that can drag the stock market lower. When spreads stay flat or fall, things are more stable, and that can support a rally. It's not some magical signal, but it is a great macro tool to add to your trading toolkit, especially if you trade the bigger indices or want to understand the bigger market picture. Now, I did also just want to mention here, if you're somebody who's already part of the Trading Edge group, which is run by TER representative, you've probably heard credit spreads mentioned a lot in there. That group does a really solid job of diving into the deeper, more complex side of trading. So if you're interested in learning more about this kind of stuff, like not like candlestick basics, but things like spreads, positioning, macro context, I definitely recommend checking them out. It's 100% free, and it's honestly one of the best trading communities I've come across. I'll leave a link in the video description if you do want to join. I'm pretty active over there, so you'll find me over there too. Thank you for watching this video, and if you found this helpful, I know it's a bit cheesy to say, but please do give it a like and subscribe if you want more content like this. And as always, I'll see you in the next video.